morning, namaskar and welcome to the course once again. In the previous lecture, I introduced you to the concepts of accounting. We also learned the various steps that we undertake in order to prepare various financial statements such as balance sheet and profit and loss accounts. In this class, we are going to learn how with every transactions your assets and liabilities are changing, and as a matter of fact it is changing your balance sheet. We will try to do this in an informal manner, not in the same manner in which an accountant prepares these statements. So, we will try to understand this with the help of some small transactions. So, let us move to these transactions. We call these as transactions 1, 2, 3 and 4. Before every transactions, we will discuss few statements. So, let us say there is a company ABC trading company. Who has opened this company? So, let us say there is a person David who after graduating from IIT Delhi wanted to start a construction company. But before starting the full fledged construction company, he wanted to start with the trading first. He had been saving some money every month from his scholarships. Now, David got his scholar degree on June 30th. On July 1st, David withdrew rupees 100,000 from his bank and announced the formation of the ABC trading company with this amount as the initial capital. Now, this I am calling it as transaction 1 or T1. What has happened? David has withdrawn 100,000 from his saving account and has opened a company called ABC Trading Company. Now, if I have to draw the balance sheet corresponding to this transaction, how it would look like? Before that, you have to understand balance sheet is basically a statement which is giving the details of the assets that the company owns and the liability that the company owes. Now, if you look at each of these accounting statements, you will find that these statements are specific to a particular company. So, you have to look for whom you are keeping these accounts. So, remember right now we are dealing with the accounting statement of ABC Trading Company, not for David. So, we are entering all the transactions in perspective of ABC Trading Company. So, the first transaction that has taken place is David withdrew 100,000 from his saving account and started the formation of ABC Trading Company. So, now if you look at the balance sheet as of July 1, how it would look like? What would you expect under asset column and what would you expect under liability column? So, as far as the assets are concerned, the company has cash asset. 100,000 has been withdrawn and is now in the account book of ABC Trading Company in the form of a cash. So, 100,000 cash is coming as an asset for ABC Trading Company. Now, what is the liability? You will find that the liability is again 100,000, which is basically in the form of initial capital. David has supplied this initial capital to the ABC Trading Company. So, that means the company ABC owes this 100,000 to Mr. David. So, what I show? I show under assets like this. Cash before this formation it was 0, now 100,000 has been added. So, my total cash becomes 100,000. So, this is my total asset 100,000. What is there in the liability? I had 0 capital before the formation of this company, I added 100,000. So, my total liability is again equal to 100,000. So, this is known as a balance sheet of the ABC Trading Company as on July 1. Now, remember every time you prepare this balance sheet, you will write as of what date, because basically this is a snapshot as on that date how much asset the company owns and how much liability the company owes. So, that is what is shown in the balance sheet as on that particular date. So, in this case you found that due to this one transaction you can record some values under assets and other values under liability column, and in this case you will find that asset is in the form of cash and liability is in the form of initial capital, and both are matching. Now let us look at other transactions. This part, recording it under different T accounts, we will come little later. We move to the second transactions. It says, just when David was about to start trading, his seniors told that he was being terribly old fashioned. How could he run a business without a bank loan? So 100,000 came from his own saving, but his friends advised, why don't he approach a bank so that they can get some loan. So on July 2nd, David went to the bank feeling a little nervous, but the bank manager recognized him. He said, you are the recipient of President Medal this year. The nation is proud of you. Well, if you want only rupees 50,000, here it is in cash. So ABC Trading Company received 50,000 in cash as bank loan. Now we have to see how this transaction is changing the composition of assets and liability. As far as asset is concerned, 50,000 has also increased in the form of cash. So now the total asset will become, earlier it was 100,000. Now you have added 50,000 again in the form of cash. So the total asset is 150,000. This is as far as assets are concerned. When it comes to the liability, how does it look like? Now further liability has increased. 100,000 was given to the company by Mr. David. Now this 50,000 is coming as bank loan. So 100,000 plus 50,000, there also you will find liability is 150,000. So if you look at the balance sheet of ABC Trading Company as on July 2, it will be something like this. Cash, initially it was 100,000, you added 50,000. So total cash becomes 150,000 and initial capital was 100,000. Now you took a bank loan 50,000, so total is 150,000. So you can see at any point of time you will find the assets and liabilities both are matching. Now I will tell you how to record these transactions in different T account also. As I told you, T account is also sometimes known as ledger. In order to visualize a T account, you can extend this line like this, so that now you can see diagram something like this, and it will give you a feel of T. So you can see it is giving you a feel of T, something like this. Now whenever some assets increase, if you remember the convention of recording transactions, I told you in the previous lecture that increase in asset is shown under the debit side. So when the company has received 100,000 from Mr. David, how I can show it? I will show it in cash book and I will show this transaction in the debit side, because my cash has increased from 0 to 100,000. So there is an increase of asset. So I am recording it under debit side. This is what it is shown here. You can see I am writing the cash T account. You can see here the transaction number 1 T1, and I have added this 100,000 and this is under capital. So Mr. David provided the capital equivalent to 100,000 in the form of cash. So I am showing it under debit side. Now I also told you in the previous lecture that increase in liability is to be recorded in credit side. So initial capital in the form of cash has increased the liability of the company from 0 to 100,000. So you can see I am recording this under credit side. So you can see every transaction is getting reflected in at least 2 T accounts. So T1 transaction, you can see it is getting reflected at 2 places, one in the cash book and the other in the liability account. Now when it comes to the bank loan transaction T2, this will also get reflected in 2 T accounts. The first one, if you look at the cash, 50,000 has been added. So you can see it has increased your asset, and so you can see it is recorded in the debit side. On the other hand, it has also increased the liability bank account. So, you will find you can write it here under liability, bank loan I am having a separate T account. So, this is reference number T2 in the form of cash 50,000. Increase in liability I am writing it in credit side. So, it is written like this. Now, I go to the third transaction. On July 3rd, David bought a small shop building for rupees 25,000, paying cash. Normally, nobody would expect you to pay cash. So, that pleasantly surprised the seller. His seniors in the municipality helped him to register the building purchase quickly in the ABC Trading Company's name. Now, this is the transaction, how it will get recorded, that we have to understand. So, the company purchased small building for rupees 25,000. So, this will reduce the cash. So, if you remember earlier I had 150,000 cash, now 25,000 is gone. So, this 25,000 is gone, but you have added a new asset, building asset, again equivalent to 25,000. So, what has happened? The form of asset has changed. Initially it was in cash form, which was known as current asset. Cash is a form of current asset. We will see these things in detail. It has transferred or it has transformed into fixed assets, buildings. So, building we considered as fixed asset. So, you will find the total asset still remains same, only the form has changed. Cash has decreased from 150,000 to 125,000 and your fixed assets have increased from 0 to another 25,000. So, your balance sheet would look something like this as on, remember, July 3. So, you can see cash was 150,000, I reduced it by 25,000. So, your cash is now 125,000 and building has been added. Initially it was 0, now you are adding worth 25,000. So, total is 125,000. The composition of liability remains unchanged. No change in the capital, no change in the bank loan. So, this is still same 150,000. So, this is how your balance sheet looks like. Now, how do I show it in the T accounts? So, cash, if you look at the cash T account, it would be, you can see it is written in the credit side. Why? Because this has reduced your cash assets. So, any decrease in asset we are showing it in the credit side. So, you can see I have shown it here. There is no change in the capital liability. So, there is nothing. There is no change in bank loan. So, no change here. You have added one more T account, which is building T account, and you can see here I am showing it as transaction T3 cash, and you are writing it in debit side. Why I am writing it on the debit side? Because this is increase of asset. So, increase of asset I am showing it in the debit side. Now, let us go to the transaction 4. Given his lack of experience, David decided to make a small start. On July 4th, he bought rupees 10,000 worth of cement as usual, paying cash. How it will change your balance sheet? What will happen? You have added some stock for 10,000. So, cement you purchase, this is a stock. Stock is again an asset. So, 10,000 worth stock you purchase. So, this will reduce your cash. So, initially you had 125,000 cash. Now, 10,000 is gone to buy this cement. So, now my cash will become 115,000 and 10,000 I will add stock. So, if you look at the balance sheet, this is how it will look. There is no change in the building. Stock has been added from 0 to 10,000. So, this is 10,000. Cash will further come down from 125,000 to 115,000. If you add it up, it is 150,000. What has happened? Again, the transformation of one form of asset has been into another form. If you look at the liability column, there is no change because bank loan remains same, your initial capital remains same. So, you find these two values are still matching. Now, how does this affect your T accounts? It will be like this. Only thing that we are adding is stock. So, we will have a separate account for stock. You can see here I am adding a separate T account for stock. You can see increase in asset I am showing it in the debit side. So, you have added this cement stock worth 10,000, so it is entered in the debit side. Transaction 5, fortune favored David. On 4th evening, the government decontrolled cement. David promptly sold his entire stock of cement on July 5 for rupees 12,000 for cash. Now what will happen? 12,000 you have earned. So your cash will go up. So increase in asset, I will show it in debit side, right, as far as recording in cash book is concerned. But before that, if you look at the balance sheet, what will be the impact of this transaction? 12,000 you have earned, right? You had purchased this stock for 10,000. So 2,000 is basically the profit that the company has earned. Now how do we account this profit? You will be surprised to note this particular balance sheet, which is as on July 5. What is representing here is building, there is no change, you purchased it for 25,000, stock 10,000 you purchased, and all stock you have sold it out. So this is 0. This selling of stock has resulted in 12,000 cash to the company. Earlier it was 115,000, now you have added 12,000, so this is 127,000. So total is 152,000. Now if you look at the liability side, capital there is no change, bank loan there is no change. Now there is one entry in this row, we are calling it as retained earnings, and this is initially it was 0, you have added 2,000. This is basically the profit. So if you add it up, you are getting 152,000. Now one thing which may be looking very odd to you is how come this profit is getting under liabilities? Now remember, for whom you are maintaining the account? You are maintaining the account for ABC Trading Company. Who had supplied you the capital? Mr. David had supplied you the capital. Who had given you the loan? Some bank had given you the loan, right? So obviously when the capital is not yours, when you had taken loan from someone, so profit also belongs to them. So when the profit belongs to them, this is again your added liability. So what you see here is, in addition to 150,000, because you earned this profit, this also is part of your liability. So the company now owes 152,000. Now if this whole money is to be retained, we are calling it as retained earning. See, you are earning profit. Now it is up to the company's management how to invest this profit. Whether you would like to keep all money with you, in that case we are calling it as retained earnings, whole amount, or else you would like to give some money back to your investors, in this case Mr. David. So that we are calling it as appropriation of profits. Maybe you can give them back in form of some dividend or in some other form. So remember, this is also the liability of Messrs. ABC Trading Company, right? If you would have incurred loss, that you would have entered in asset side. If you are earning profit, that is your liability, right? So this is how you have to interpret, right? Now we move to the next set of transactions, but before that, how this is affecting the T book or T account, that also we need to see. So you can see, before that you can prepare the income statement or profit and loss account. It is very simple. You made a sales of rupees 12,000. Since this is a trading company and you didn't incur any manufacturing expenses, this is written as 0. You purchased the stock for rupees 10,000, so this is your profit. So in formal manner you can show this profit and loss statement like this: how much was your sales, how much money you really incurred in procurement of those goods, and in turn how much did you make the money, right? So this is what it is. You can see very clearly I am showing it between 1st July to 5th July. When it came to balance sheet, I was giving a firm date here, 1st July, 2nd July, 3rd July. But when you talk of income statement, sometimes which is also known as profit and loss statement, you are showing the whole period. Let's move further. On July 10th, David got married to his old schoolmate. Rest of the July, David was holidaying. Now, after they came back from holidays, they started Mr. and Mrs. David Company. This is a new company. So, on August 1st, David put in rupees 50,000 cash as capital and persuaded his wife to give an interest-free cash loan of rupees 75,000. So, based on this, can you now prepare the balance sheet and you can show what are the assets of the company and what are the liabilities? Now, remember, we are doing the accounting for Mr. and Mrs. David Company, not for either Mr. David nor for Mrs. David. It is for Mr. and Mrs. David Company. So, what are the assets? Assets are cash. 50,000 contributed by Mr. David, 75,000 contributed by Mrs. David. So, total cash asset is 125,000. When it comes to liability, it is again 125,000. That is in the form of capital and loan from Mrs. David. So, this is how your balance sheet would look like as of August 1st. This is for Mr. and Mrs. David Company now. So, cash increased from 0 to 125,000. So, this is 125,000, total is 125,000. Capital, it was 0 initially. So, after the formation of the company, 50,000 was contributed by Mr. David, 75,000 contributed by Mrs. David. So, total it is 125,000. You can see assets and liabilities both are equal. Now, if you have to enter these in different T accounts, how it will be done? I will show you a little later. On August 3rd, Mr. and Mrs. David Company bought office furniture for rupees 10,000 paying cash. So, how it will change your balance sheet? Now, cash will get reduced, right, by 10,000. There won't be any change in the liability. So, if you look at the balance sheet as on August 3rd, it would be like this. Cash 125,000 minus 10,000, it is coming to be 115,000. Furniture, there was 0 stock here earlier, you added 10,000. So, you can see you are still having 125,000 and there is no change in the liability side. Is it clear? So, you can see at any point of time I look at the balance sheet, my total assets and total liabilities are matching. On August 10, David bought rupees 50,000 worth of bricks on credit, agreeing to pay the seller in 2 weeks. Now, remember, this is not a cash transaction, no cash, this is on credit, and Mr. and Mrs. David Company promised to pay the seller in 2 weeks time. So, cash has not exchanged its hand, right. So, how do I show it? First, I will tell you how to prepare the balance sheet, right. So, what is the asset? Now, you will find cash there is no change, furniture there is no change, but you added another stocks of bricks worth 50,000, right. When it comes to the liability, I will show you how it changes. So, let us see. Cash, this was earlier, we have purchased this bricks for 50,000. So, stock is 50,000, it was 0 earlier. Furniture there is no change, cash there is no change, 115,000. So, my total asset now is 175,000. Now, when I look at the liabilities, you can see capital there is no change, loan there is no change. Now, I have added another row called creditors. Creditors are the entity who have provided you services, but you have not paid them right now. You will be paying them, and Mr. and Mrs. David Company has promised them to pay in 2 weeks time. So, till the time you pay them, this is an added liability. So, you can see 50 plus 75 plus 50, this is adding up to 175,000. So, both are matching as on August 10, right. Now, let us move further. David's luck still held. Brick prices went up sharply since government banned the brick kiln in New Delhi. David sold his entire stock on August 15 for rupees 60,000. The buyer promised to pay in a week, right? How does this affect your balance sheet? Now what will happen? You have an entity called debtor. Who are your debtor? Debtor are the entity to whom you have provided some services or to whom you have sold some goods, but they have not yet paid to you. So they are your assets, they are the company's assets, because today or tomorrow they are going to pay you, right? So what I will show in assets column is like this. I have an debtors, it was 0 earlier, I added 60,000 here. All my stocks were sold out. So whatever bricks I had, I sold it out all. So this stock is now 0. There is no change in cash, there is no change in furniture. So if you add it up, it is coming to be 185,000. What is happening in the liability side? There is no change in capital, no change in loan. Creditors, there is no change because I am yet to pay them. You can see this transaction has added another 10,000. Why? Because you purchased the stock for 50,000 and you sold it for 60,000. So you made a profit of 10,000. Now this 10,000 is not yours money, not the company's money. You owe it to your investors, Mr. David and Mrs. David. So this is also a liability as far as the Mr. and Mrs. David company is concerned. So I am assuming the whole profit is coming as retained earning. So I am showing it in the liability column, and if you add it up, the whole 10,000 plus 50,000 plus 75,000 plus 50,000, you are getting 185,000. So here also you can see your assets and liabilities are matching. The brick purchaser turned out to be reliable and paid rupees 60,000 promptly on August 22nd. David, who had been quite nervous, heaved a sigh of relief because he had done this transaction on non-cash basis for the first time, and his purchaser proved to be very reliable and he paid rupees 60,000 promptly as promised. How this will change the composition of assets and liabilities, we will show in the next slide. So 60,000 cash you have received. So this cash asset is going up from 115,000 to 175,000. There is no change in furniture. Stock is all depleted, it is 0. Debtors 60,000 was there, now they have paid you back. So this is 0. So what you find? This is still 185,000. So what has happened? Debtors, which was asset here, has been converted into cash form, right? So this is how assets would look like. There is no change in the liability. You can see still it is 185,000 and all these entries remain unchanged. David, under pressure to keep his word, now that his debtor had done so, paid the amount due to the brick supplier on August 23rd. So he also has to keep his promise, because remember he had taken this stock on credit. So whatever 50,000 worth stock he had purchased from this person, he has returned this money on 23rd of August. So how it will reflect in the balance sheet? This is how it will look like. Cash, you have given 50,000, so this will come down from 175,000, now it is 125,000. There is no change in furniture, there is no change in stock, there is no change in debtors. So your total asset is 135,000. You can see creditors, it was initially 50,000, now you have given the money back to them, so this is 0. If you add all these, you are getting 135,000. So this is how you go on doing the or making changes in the balance sheet. Now what about me, said Mrs. David. Now that you are earning a lot, how about repaying my loan? David, after much thought, paid rupees 25,000 on August 31. If I pay the entire loan, people will think that I am an easy target. So that's the reason he couldn't repay the entire amount. How it will affect the balance sheet? You can see here, cash will further come down from 125,000 because 25,000 is being repaid to Mrs. David. So the total cash now remaining is 100,000 for the company. Furniture no change, stock no change, debtors no change. So this is coming out to be 110,000. Now you can see loan amount has come down. So 75,000 it was there initially, now it has come down to 50,000. Capital still 50,000, creditors nil, right? Retained earning no change, so total is 110,000. So this is the balance sheet as on August 31st, right? Now if for the same period from 1st of August to 31st of August, if you want to plot the income statement or show the profit and loss statement, how it will look like. There was a sales for rupees 60,000. You did trading, no expense were incurred in manufacturing, so this is 0. Material was worth rupees 50,000, so you made a profit of rupees 10,000. So you can see from all these transactions how assets and liabilities change and how your balance sheet changes. This was an informal way of understanding the balance sheet. What you have to understand here is that with every transactions your balance sheet changes. Now whenever a company enters into transaction, it affects multiple T accounts. At the time of preparation of balance sheet and profit and loss account, you also have to cater for adjustment entries, right? Once you have catered for adjustment entries, you can prepare the initial trial balance, you can find out the balance sheet or rather the profit and loss account, and subsequently you can draw the balance sheet. So these are the various ways in which you can understand the balance sheet and the profit and loss account. In the next lecture, we will tell you the formal way, the manner in which an accountant prepares balance sheet, what are the steps that they follow, because if they have to follow the method which we followed in this class, you will find that it will be a hell of a task. So they have a different way which may be slightly difficult to understand, but we will try to do the accounting thing using the same small example, and you will be able to understand the formal way in which these statements are prepared. So we stop at this particular point and see you some other time in the next class. Thank you.